we haven't seen the market take a break. I mean, if you think about this market didn't take a break through this, August, September correction. This market didn't take a break with the October low to November rip, November, December, little pause for the holidays for like a week. And then January, February, March, didn't take a break in April with the correction, didn't take a break in May, hasn't really taken a break in July or June just because we had the big CPI gap. And so direction is still pushing, but we haven't seen, when you have trend and trend and trend and trend, what happened to this? What happened to just nothing? What happened to sideways? What happened to consolidation? I mean, if the dollar can do it for a month, the stock market can certainly do it. So you're probably onto something there. And I think that also means that you have to set some proper expectations. And, I know for me, like I'm going into my portfolio here, like I'm going to be taking another close look, going through with the comb and trying to figure out like what else can I be doing with my positions. A lot of these are in red today. But it's because we just have aggressive shifts. A lot of these are option trades being sold. But Apple, I mean, this shows like I am down, but it's like I'm up $3,000 on Apple. I'm just having like an overall like portfolio pullback. But I mean, I started this portfolio at like 1.8. So it's doing okay. It's just I've got a red day. But I mean, position wise, I'm still watching. I mean, I look at all these positions like I have a case that I'm trading. I have a core position in all these that I'm interested in trading. And, I take the green and the red in stride. And I like some of the positions. I think that I might take some assignments on some Chinese stocks in the next maybe 30 to 45 days, which I'm okay with. But obviously I don't want to see, like Alibaba is like this big cash cow sleeping giant that just doesn't get any love in the market. And I don't know why. I mean, I thought once we finally cleared this hurdle on the right side of the trend line, this thing would be ready to rip. Lifting animal spirits and looking for kind of the global growth scenario hasn't really had any follow through. So I have a lot of interest in this stock, but I also might have to temper my expectations with might be choppier for longer. So same thing could be translating into our stock market, which is up and up and up and away. But at some point, even if we get the oversold or overbought conditions, even just a 1% to 2% pause that goes from high to low, and we have like a little 1% to 2% range, I think that would be enough to kind of just slow this thing down a little bit, let the market catch up, and then we get into another earnings season, and then we see if that's another kind of broader catalyst to see things go better. We get into obviously like August, September. I really think the market is waiting with bated breath on September. After this week, let's actually check this. The Fed Watch tool, coolest, dumbest tool ever, because it changes every single day until it's the day of FOMC. Right. So July expected to be a pause. September, it's. I mean, this was up to like 66 or 67 right after the FOMC, and now it's down to 61. I still think the probability is the market expects a cut in September, but maybe one cut.
I just don't think that's the case. And so here's what I found from
when you
Yahoo.
say the case. When you say the case, let me ask you this: when you say the case, you think that the market's not going to cut? You don't think the Fed's going to cut in September?
No. And
okay.
That's
the risk. That's a risk-off event then. If that's the case and this thing flips, because look, this tool has never been wrong since 2009. Now they stick to that because it changes so much. Of course, it changes all the time.
So I think,
but that change is where the sell-off occurs, right? Like when this is going to change and say, crap, there's no rate cut, something's going to get priced in. Like this market will react and have a tantrum and sell off when they believe like, oh fudge, now the rate cut's not going to be till December, or maybe not at all because it's an election year. Who knows?
Once it happens, yeah, that sell off will likely come. But I'm just looking at if you take forecasts. So me and Nick like didn't buy this initially when they wanted. He said 3 rate cuts this year, and people expected the first one in March. This is old news.
Yep.
But this is comparing the forecasts going forward from March when they made this report to now.
Okay.
So now what we're seeing is a broader
of no cuts
consensus of maybe 1 cut this year.
Yep.
And a slower decline in inflation over time, or interest rates over time. So this change from 3 cuts to 1 cut, we're 6 months into the year. Who's to say that we get to October, November, or say we're at September and he's still saying the same thing, that we're not confident yet?
He totally
And
will. He
and
totally
you're
will
looking
say
at
the same thing.
inflation from last year, this time to now, we're at the same spot. Whereas in Europe, they've seen a big decline. There is stubborn inflation there. They might have been premature on their rate cut too, but they're at least seeing a trend. We are not seeing any trend in inflation. It's still in the same spot. It's gone up, it's gone down. We're at the same place we've been in. There's no progress. So where would people get any confidence that we're going to see a cut unless we see some kind of trend down lower, below 3, or what if we can eventually get to 2? That's the question. Is are we going to see that trend down, or are we going to stay where we're at? And if we're going to stay where we're at, what is the rationale of cutting?
Did you know that we have 100% free trading tools and data available for you on our website, a1trading.com, right now? We have free courses for you to browse. You can also check out things like retail sentiment and free articles from our analyst Frank that include things like Edgefinder screenshots and trade setups. You can find all of this and so much more for free right now on our website, a1trading.com.
And there isn't one.
It's true. Well, and again, not to be political here, but and obviously the Fed is not supposed to be political, but I do think an important feather in the Biden administration would be if the Fed cuts and this market can rip and melt up and capitulate, that might be enough of a economical highlight to maybe lean Biden administration as a staying incumbent versus, I don't want to think
you're
Biden
right,
Trump.
but a cut will do more damage than good.
I don't disagree. I don't disagree, but I think the reality is, if this wasn't an election year, I don't think that the market gets anything. But because it's an election year, I almost think that the market is willing or wanting, and the Fed is willing to play a little bit of political inside baseball to be like, here's a test. Like he said this on Wednesday, by the way. Jerome Powell said this. If I were to look in the long term, and this all was a 20, I'm paraphrasing obviously, but like a 25 basis points cut on whether it was good or bad. I mean, in the grand scheme, if we're ultimately trying to get rates down to 3%, a 25 basis points cut, whether it's September, December, or into 2025, really doesn't freaking matter. It really doesn't matter. But the market right now cares so much about it. But I don't see his narrative changing. That's what you're spot on. Like, I don't think he's going to change how he says, what he says, every single meeting or every single FOMC minutes that we read. It's going to be the same thing. And it's just going to be a matter of what happens to see, like, okay, so we'll have July prints and June CPI or inflation data. We'll have August prints to July's data. We'll have, September prints to August data. So we'll have 3 more rounds of inflation data before the Fed has to make a decision on September 18th, right? And so this gauge will change. Whether it's up or down, we don't know. But I think right now the Fed has put the market in a way. I think the market is going to be able to kind of chill and go to sleep for the next maybe 60 days because the language hasn't changed. And unless we have like a big, wild, crazy earnings season, even that could we've been really, really lucky, dude. I mean, honestly, how many trades have we taken in earnings season this year so far to the halfway point where they have blown through expectations?
Yeah, the majority of them.
Tons of them. And so I'm happy that we've traded options the way that we have. I mean, if I show, let me go to my equities. I think I tracked this and took the profit already. Oops, that's my tracking sheet. Yeah. So if I go to my tracker here, so I think I updated this already. If I didn't, I will. Okay, so Adobe, yeah, so we're updated. So profit on Oracle, profit on Qs, profit on SPY. I just look back here. There's way more green than red, and a lot of these have been option earnings plays. Way more green than red. Like I have like 69% wins, 70% wins on a lot of these trades with even risk rewards. I mean, it's been pretty easy to carve out some pretty good profits here, just trading the market's excitement. And earnings tends to get the market excited. You know, Adobe, for example, that is a blowout type move that they did mention AI, right? And it's like, it's so dumb, but it's also like, who cares? It's a nice way to make some money. And the trade is done.
Yeah.
And it's, I mean, you take the trade on a Monday or Tuesday, and it's Friday, and you can take profit today. I mean, the SPY, the Qs, I took the trade Mondays, took the profit on Wednesday. It's like, that's awesome, dude. So anyway, my point is, it's been a good season, but it's like, I'm also prepared for like a crappy earnings season that like the market doesn't get too excited and there's not enough volume to really push it around. But it's you never know, man. It's like low volume markets can also be the perfect window for like these blowout moves because it gives the market something to latch onto. You know, exciting earnings season can get these markets to move. What's that?
We've traded earnings.
Yeah.
We've seen volatility in the SPY as well, or in the indices, but we've noticed that it's dying down. What can we look for now? What are our new plays? Are we, with low volume, low volatility, it's probably not going to be great for selling options either. So
I know that's what we talked about this week. It's like I hate it. I hate that. So index wise, like let's go to the SPY. So I was looking at that tasty study that I would love to take this trade. This is a 0 DTE trade in the SPX. Every single day you could collect $3 to $4 of credit and then manage that for a quick, $60 to $70 of profit. And if we have a low volatility environment, dude, you could take the trade by 9:30 and by 10:30, 11 o'clock, you're out with profit and you're done. Example would be, let's talk about this for today. So if I did this trade today, and I should have priced this thing and just had it hypothetical, but I was already live in my session. So we opened today. This is a perfect example. We opened today at 541. Okay. So if I go to my option chain on the SPX and we do a 0 DTE. So here we open at 541. Is that right? Oh, I got to go. No. I got to go SPX. So let me get back to this chart here. SPX. I got to find out where that opened. There. So SPX opened at 5425, roughly. Open there. Okay. So let's see how much we collected. If we were at 5425, that's where we opened. So that would be 20 points up would be 45. I'd sell that call. And come on. Oh, I got to clear this out. 5445. And we opened at 25, so we go to 05. So that's my trade. Now, in a strangle, okay, an SPX strangle, you can see here you're still able, if you took the same trade with the same legs, you're at $6.40 credit right now. I've got to wonder if this was a trade this morning, what this initially traded for. So I'm gonna get a ballpark here, and if we're currently trading at 54.15, let's go 20 points up and 20 points down. So to 95 there. So if you're collecting, man, I don't know what it would have been an opening bell. I would imagine you're getting like $6 or $7 worth of credit. And right now you have the put side would have been tested a little bit. So 45 to 05. Your put side is being tested a little bit, but you're still okay. Your call side's probably mostly in profit. But I don't know what the opening bell trade was. So all I'm saying is, look, we're trading at a 13 IV rank. This week it was literally at like 4 and 5. It was a low volatility. It's jumped up a little bit, which helps the premiums. But what I'm getting at is, if there's an opportunity to take some daily trades or even go out a week and take some of these trades, or just go after these really tight take profits, that might be my plan. If I want some income, I might be looking to take some SPY trades or some SPX trades and just let the market be boring and try to squeeze out something. But to your point, selling options right now with a low IV, it kind of sucks. It's way better when IV is higher because you get way more premium up front. But if you got to settle for it, I mean, I looked at all the Tasty Live studies, and I mean, they go back 30 years, man. So we've had low IV, we've had high IV, and it's just, you take the same trade. It's like, whether it's low or high IV, it's like, it's the same mechanical methodology, and you just take the trade. So
I'm
I'm trying, dude. I want tons of trades, but I just got to think about everything, you know.
I've gone from, you know, like the iron condors into credit spreads, and now I've just resorted to straight up calls and puts that I buy, like 1D DTE. So I can't really do day trades. I can do a few, but I'm limited. So I like going a day out at least.
Yeah.
And those they move very hard, very quickly, and so far they've worked out. But I've had a few where, you know, if you're wrong, you're pretty much totally wrong because you don't have any time. But it's nice to have these quick moves, and then you can just get out, be done for the day. So I like that, but you know, that does come with a certain amount of risk, because you obviously right now, I was liking these plays below the highs, and now that we're at all-time highs, or basically right there, it's hard to kind of tell, like, do you want to even have a call in play? Like, say you bought a SPY call at 541, and it costs I don't know, $3 for
Right.
a 1 day out.
Yeah,
Do you
you
think
need it to
it's
break
gonna-
all-time highs.
Yeah, do you think it's going to break all-time highs by the next day? I mean, it could, but I don't know. The options, or put options, are a little cheaper. So the room to the downside just seems better. So it's something you just have to weigh. If the market pulls back, then maybe a call option will be good. But I was playing CPI. I was hoping that we get a lower number. Well, I was hoping we'd get a higher number, but then I flipped last minute, and
Well,
just
worked out
bought
pretty well.
calls I bought calls at the end of the day, and it just outweighed my market value of puts, and so it ended up working out. But you know, I thought, you know, we're not at all-time highs. Maybe this will take us back up there, and then it did. And then now I kind of ran out of trades to make, so I'm kind of just sitting on the sidelines. But
Yeah. Well,
it's
if
hard.
think, let's talk historical context of the market too. If you are reluctant to buy at highs, you're going to miss out on a lot of profit, because the one thing these markets do, and you can go back to you can go back for the last 20 to 30 years. I mean, 90s was a bullish market. We had a crash in 2000, 2001. We got through that. We had a pretty decent run to 2007, 2008. Post 2008, it's been one of the greatest bull markets we've ever seen since 2020. Like that's when it all corrected, was 2020. But you had like a 10, 11, 12 year, mostly uninterrupted, outside of having some, you know, some Fed backstopped, like 2018 end of the year sell off. 2019 was all up again. But my point is, there are times in these markets where all you get are higher highs. I mean, the last, let's go Q4 to Q1 of 2023 into 2024. All the market did was rip higher. Every single week for, you know, 16 out of 20 weeks was higher highs. So if you're not buying highs, if you're not positioning for higher highs, you're going to miss out on profits. If all you did in the stock market was, I need a dip, I need a dip, I need a dip, dude, you might not get it. So, I mean, I look at the performance of, have you ever seen a chart where it compares like the best days versus the worst days? And if you're not participating because of just, you want to time it so well, if you're not participating in all the best days or even the worst days and still buying in, it's like there's so much profit and movement that you miss out on.
Yeah, there's no point in trying to, you know, get the short plays in when we're in an uptrend. And even if you're bearish, like I don't know if I'm necessarily bearish. I'm not bullish on the stock market, but it's in an uptrend and nothing is cracked. There's really no point in going against it unless you start seeing something where, you know, the floor gives out.
That's exactly it. And that's this chart right here. That's this chart.
Look, the way
Right. That's
just
the floor.
looking at the shape of this trend, why would you really go against it? I guess just position yourself for, you know, higher moves and just. If you're wrong, it's okay.
Let's say there's a top, right? Let's say there's a top. This type of trajectory from this April decline to this May rip more than likely is not going to be faced with another April decline, right? There was a lot of, this was a lot of the confusion of, is it 3 rates? Is it 3 cuts to 2 cuts to 1 cuts? Is it 0 cuts? That was all this drama. Plus inflation was ticking higher. Oil prices are going up. All these things were dampening the overall like inflation recovery. Once that was put to rest for a second, and then all of a sudden we had, a huge market rip on just overall earnings, biggest market cap stocks doing really, really well. Here we are. March is done. April's done. Like, that correction's over. At this point, I see any correction being more of this rounded, right? And then all of a sudden it just kind of breaks and leaks. It's like if you're in a rocket ship and it's running out of gas, it's still going to drift with a low gravity orbit until it doesn't. And so rather than being bearish, like I said, protect your profits, play some defense. Look, you can start getting positioned into more defensive plays. I mean, I've got stocks that are value stocks. I've got stocks that are defensive. I've got sectors that are defensive. I've got stocks that are, stocks in sectors that are uncorrelated. I'm in the VIX, so if there's a really aggressive push to the downside, I'm positioned for that. So I'm trying to play some speed chess with the market. But to me, this seems like a rounded out top is how this thing, just like it did here. This took its time to then finally cave and the floor broke. So until we break this trend line, I have a hard time really painting a bear case. So I'll continue to take my stabs. Like look, my style a lot of times, Frank. Like, I like these 1-2 week expirations, and if I was confident that there's like such a stronger move ahead, I would have positioned out to the end of the month instead of this week. But instead, it's like I'm going out to July, and I'm just like, you know what? If I can get a $10 to $11 move somewhere directionally for the next 30 to 45 to 60 days, I'm fine with that, and I'll pay for that, right? But right now, it's like, I'm with you, man. I don't know if we're going to get a lot of additional direction, because right now I feel like we're running out of catalysts. We've had the inflation news, and we had the Fed, and we had our earnings in. So it's like now things have to start back over with, earnings kick off with financials, and it's really boring typically. So you got banks, you got blue chips, and then you get into like the Mag 7 Fab 4, the big tech stocks, and then things get a little bit more interesting. But I mean, it stretches like 4, 5, 6 weeks. So it's not going to be for a while. It's going to be starting in July.
So I think in this sort of market, you look for drifting higher, but also just look for new lows on the VIX, because that has been a good indication so far this year. In March, on the screen I'm sharing, we have the VIX hits new lows on March 28th, March 27th, and then March 28th it comes back up slightly. It's not really an indication of anything, but I think hitting these lows is that indication. So we have from March 21st to 28th, we're basically at those lows. That's
there.
And from then on, we have March 28th, and then all of April up until like late April, you have this downtrend. So I would say every time you see these dips to lower levels, look for potential plays to maybe pad your account just in case something bad happens. Don't leverage for the big short. Don't try to be the hero. But when you see the VIX hit these new lows, if this comes down under 1140, 1151, I guess, comes down and makes another low, maybe look to hedge a little bit to protect yourself. But I think that's the market we're going to be in. And I guess because we're in an election year, can't afford to see a crash.
It's true. And I think that's probably the best summary of this year. It's like how resilient and how many blinders, or how strong are those blinders on the market to be like, we're just going to keep doing this. Nothing else matters. Let's keep doing this. That seems to be the play right now. But that also that does get me very, very defensive going into 2025. I think there's a lot of realities that a new administration or even a carryover administration has to worry about. It's been a really nice recovery, right? From a 2020, we bought our way out of it. 2022, we survived it on the backs of the biggest stocks in the world, with a very hawkish Fed, with a crazy rate hike cycle, effed up our bond market. It's market manipulation like crazy. But here we are at all-time highs once again, where it's just a weird thing to have markets at all-time highs, household equity at all-time highs. Consumers are probably a little bit strapped and spending on credit, but nobody feels good about this economy. That's what is that just me, or is that the consensus? Like, not a lot of people feel great about the economy and feel like there's so much crap, but it's also what you ingest. If you watch drama news and it's doom and gloom, that's gonna invade your thoughts. So I mean, I hate the news. I never watch the news. I read financial news because that's the data that I use to make decisions. But man,
Right.
I couldn't tell you the last time I care about anything that's not financial news related, because that's my wheelhouse. So
I think we're just going to pay for it at some point, though.
we will, and we should. I mean, it's like you can't. How did 2000 happen? False valuations and crazy high valuations that are unicorns, right? How 2007-8 happened? Irresponsible over leveraging, and so many delinquent, non-qualified buyers out there. It's like that was a crazy Armageddon type risk in the financial markets, with like the entire housing market. You're betting against bonds, you're betting against the housing market. That's never happened. But here we are, 2020, I don't know what you call that. 2020 was ripe for a correction. They just put the bow tie on it, called it COVID. But it's not COVID that crashed the market. It was the abrupt reactionary decisions that all of a sudden, like, the whole world came to a halt. Everything stopped, everything closed. And then you're thinking, is the global economy now completely forever changed? But what do? We bought our way out of it. So, eventually, I think that's the problem that we're in, is we have boom and bust cycles that you can't avoid. That's going to be the scariest part, is we're going to have another crash. 2008 to 2020 was a long stretch, but I keep going back to this, and I think we talked a lot about it this week. That stupid inverted yield curve is going to come back and be the reality check that the market has been ignoring for a while. The deepest and longest historical inverted yield curve at some point is probably going to matter, and at some point the market's going to pay attention to it, and it's going to tie on and layer on all these Jenga pieces of, like, this is what's enough to finally get the market to tip over. And like we talked about, the scary thing would be market starts to tip over, momentum starts to pick up to the downside, and the Fed steps in and starts cutting, and the market doesn't give a crap about it. Just keeps going down, down, down. That's the scary thing. That could be that 20, 30, 40% correction, and the Fed can do nothing about it. That's the scary thing to me. Does that mean that everything's ending? No, it just means that it's a cleanse, and hopefully you're not on the wrong side of that move. Hopefully you can hedge well enough and you can walk away, profitable because of it, or you can just be unscathed. But if you're not protected, that's the worst scenario, is just like all-time highs and then watch a 30% cleanse do nothing but take away all your hard-earned investments.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.